Hey gang, Larry Bailey here with another weekly newsletter. Today is June 17th, 2024, and this will be the week of June 10th, 2024 in review. I'm recording this while at the terminal in Chicago, so if you hear any background noise, forgive me. If you don't hear any background noise, thank you, Shure Microphone. This information is brought to you from MBS Highway, your trusted source for mortgage market intelligence. And also, if you run a business and you have commissions that you're paying out in your payroll, you need to get over to awesometechinc.com. You need to check out, sign up for a demo, see it in live action, the eCompensate and eCompensate Pro. The eCompensate platform will modernize and automate your entire commissions and bonus structure for your entire payroll. The Pro part actually includes expense management. That's right, expenses also. So all in one place. Check out that information. Get over to awesometechinc.com. Let's get into this newsletter here. So again, this is for the week of June 10th, 2024 in review, and the Fed once again held rates steady while tamer than expected consumer and wholesale inflation for May was a welcome sign. Unemployment claims also saw a big move higher. Here's last week's highlights, that is. Fed holds rates steady, indicates one cut in 2024. Next story is consumer inflation takes important steps lower. The next story is friendly wholesale inflation numbers. The next story is inflation jobless claims hit a 10-month high. And the next story is latest on small business optimism. So first story, Fed holds rates steady, indicates one cut in 2024. So after 11 rate hikes since March 2022, the Fed once again left their benchmark Fed funds rate unchanged at a rate of 5.25 to 5.5. This decision was unanimous and marks the seventh straight meeting they held rates steady. The Fed funds rate is the interest rate for overnight borrowing between banks from the Fed and is not the same as mortgage rates, of course. The Fed has been aggressively hiking the Fed funds rate throughout this cycle of monetary policy to try to slow the economy and curb the runaway inflation that became rampant over the last few years. So the bottom line here, gang, is while inflation has cooled considerably after peaking in 2022, it remains above the Fed's 2% target. Fed Chair Jerome Powell reiterated the Fed does not expect to cut rates until members are confident that inflation is moving sustainably towards 2%, as measured by annual core personal consumption expenditures. That's the PCE, gang. We've talked about that a few weeks now, which currently is just at 2.8% as of April of 2024. The Fed's, quote, dot plot of member forecasts signaled that just one rate cut is expected before the end of the year, down from 3 cuts forecasted in March, though these estimates can quickly change based upon upcoming data. The Fed did acknowledge that they have seen, quote, modest further progress towards their 2% goal, reflecting some recent friendly inflation readings as noted below. And by the way, if you're listening to this on podcast, thank you. If you want to check out the full video with everything on screen, including the family hack of the week, make sure you get over to Mortgage Stock Community and check it out there. So the next story is consumer inflation takes important steps lower. On screen, we've got Consumer Price Index. This is an image brought to you from the Bureau of Labor Statistics. You can check that out and how that trend line's been going over the last 12 months. So May's Consumer Price Index showed cooler than expected inflation, while the headline reading was flat for the month, and also while the annual reading declined from 3.4% to 3.3%. The core measure, which strips out the volatile food and energy prices, that increased 0.2%, and the annual reading declined from 3.6 to 3.4%. So all of these measures were softer than estimates, which is really good if you're thinking about mortgage rates right now. Not necessarily bad at all. And so as moderating motor vehicle insurance costs were a key reason for the friendly core number. Who would think like motor vehicle insurance would do this to us? But again, it's real money out of all of our pockets. So every dollar, every penny counts. So the bottom line here with this part of the story is May's data followed better than expected numbers in April. And this is a welcome sign that inflationary pressures may continue to ease as we move further into the year, especially after the readings in the first quarter of this year were unexpectedly high. Here's the next story, friendly wholesale inflation numbers. So where we think about the Consumer Price Index, which is the retail side, this is the Producer Price Index, which is the wholesale side, and it measures inflation at the wholesale level, and it was below the estimates for last month. The headline PPI fell 0.2% in May, with the annual reading also moving lower from 2.3% to 2.2%.
The core PPI, which strips out volatile food and energy prices, was flat in May, and the year-over-year reading fell from 2.4% to 2.3%. Bottom line here, the favored CPI and PPI, that's the consumer price and the producer price indices. Those reports brought a double dose of positive inflation news last week. Positive meaning inflation is getting better. Plus, some of the PPI components are factored into another important consumer measure called the personal consumption expenditures. That's that PCE measure I talked to you about a few times now over the last few weeks. Remember, this is the Fed's favored measure, and this could lead to a friendly PCE report when that data is released later this month, June 28th. We shall see, fingers crossed. Next story is initial jobless claims hit 10-month high. So the initial jobless claims rose by 13,000 in the latest week, with 242,000 people filing new unemployment claims. This was much higher than the expectations of 225,000. There were also 1.82 million people still receiving benefits after filing their initial claim, as continuing claims jumped by 30,000. So the bottom line in this story is initial jobless claims have now risen for 3 straight weeks, with the latest reading at the highest number for the first-time filers since August. Continuing claims also still trending near some of the hottest levels we've seen in recent years, suggesting that the pace of hiring has slowed. The Fed will closely be watching for signs of sustained rise in unemployment as they weigh monetary policy and the timing for rate cuts, given their dual mandate of price stability and maximum employment. And we're on to the next story, and this one's all about latest on small business optimism. So the National Federation of Independent Businesses, that's the NFIB, Small Business Optimism Index rose to 90.5 in May. While this is the highest reading in the year, it remains well below historical averages of 98. So what's going on here? The NFIB's chief economist, Bill Dunkelberg, explained that, quote, for 29 consecutive months, small business owners have expressed historically low optimism for their views about the future of business conditions are at the worst level seen in 50 years, close quote. Given that 22% of owners reported that inflation was the single most important problem in operating their business, the cooler than expected inflation readings for May were a positive development. Here's that family hack of the week. And by the way, you're only going to see this recipe if you get over to mortgage.community. If you love cherry tarts, you want to check out this recipe. There's a cherry tart recipe courtesy of the Food Network. It's perfect for marking the National Cherry Tart Day on June 18th. That's tomorrow. So get over there and check it out. If you love cherries, it will not disappoint. Here's what we're looking for the rest of this week, gang. Housing data is plentiful, starting with Wednesday, with an update on home builder sentiment for this month. Look for May's housing starts and building permits on Thursday, while existing home sales data follows Friday. Also of note, May's retail sales will be reported on Tuesday, with the latest jobless claims on Thursday. Plus, we'll see an update on manufacturing for the New York region on Monday and the Philadelphia region on Thursday. So there's a lot going on. Keep in mind also, the markets will be closed Wednesday for the federal holiday for Juneteenth. So up in the upper right, we see MBS is trading at par 0.66. Par is another word for 100. So that's there. And then also 10-year Treasuries yields increasing. So we're seeing a little bit of a wrong direction here. Hopefully, the markets will see information that they like this week to get interest rates to go lower. My name's Larry Bailey. Again, if you're running any business with commissions or bonuses, you have to check out eCompensate. Get over to awesometechinc.com, and I'll see you next time. Take care.